information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situation, or specific needs of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
So, kind of looking back on the quarter, we'll get into some of the specific drivers of performance. Obviously, the big one kind of being the tariff shock in the beginning of April. But just purely looking from a performance standpoint, was obviously an excellent quarter. We had the S&P up over 10%, the NASDAQ up about 16%, and the Dow up about 5%. And like I said, a lot of that was driven off the back of the initial tariff shock that we saw and then kind of the rescission of those tariffs. But that kind of performance in a quarter is nothing to kind of scoff at. So if we go to the next slide, we can kind of talk about some of those drivers for performance. So this is just a similar graph, but kind of overlaid with the Mag 7 performance. One of the things that we talked about in the first quarter, there was a lot of skepticism, a lot of uncertainty kind of surrounding where tariffs were going to go. We saw markets modestly down in the first quarter, but one of the bigger stories of the first quarter was kind of the underperformance of the Mag 7, the underperformance of tech stocks, and kind of the AI theme. And like I said, I think a lot of that was driven by the uncertainty of tariffs. So obviously, to start the quarter, beginning of April, we saw the tariff shock and, kind of the initial blanket tariffs that were initiated by the U.S. And obviously that caused the markets to drop, roughly 10 to 15%. So coming off the back of that, we obviously had a little bit more prolonged period of uncertainty. Throughout April, markets were kind of bouncing back and forth. But towards the end of April, we saw President Trump, kind of scale back those tariffs and kind of push the deadline down the road, which kind of gave markets a little bit of room to breathe. So obviously, as you can see, and like we talked about in the last slide, markets responded very positively to that with great performance. So like I was saying, in terms of Mag 7 last quarter, we kind of saw underperformance relative to kind of how they performed relative to the benchmarks on previous quarters and previous years. And that kind of returned to normal in the second quarter. So, as you can see, the Mag 7 really drove performance there. And that's kind of off the back of, the resurgence of the AI play. So, mega cap tech stocks really powered kind of the impressive quarter for the markets, and kind of continued hope for the theme's dominance down the road. I think a lot of people are, think very positively about AI. I think that's one of the things that many people are, bullish on for driving performance in the market going forward. Another kind of driver of performance in the first quarter was rate cut expectations. So rate cut hopes, also helped to push markets higher. We saw, softening inflation data, and then, a job market that, started to show signs of cracks. While we didn't see any rate cuts in the second quarter, traders are pricing in about 2 cuts for the rest of the year, and that's kind of buoyed hopes for the market as well. And then just one note on this graph, I think it's important to note that this is just the second quarter performance. This type of volatility and this type of strong positive performance to end the quarter, isn't typical. We usually don't see that over a 3-month span, but obviously the tariff situation kind of drove a lot of that uncertainty and as such the volatility. So we can run over to the next slide. So just kind of talking about sector performance and valuation, like I said, it was kind of a return to normal in the second quarter in terms of technology stocks and kind of the Mag 7 AI theme. So we saw pretty strong performance from sectors like information technology and communication services, as well as consumer discretionary. On that same token, some of the more defensive sectors, you think like energy and healthcare, that really performed fairly well in the first quarter amid kind of the tariff uncertainty that we saw, posted negative returns for the quarter. Energy at about -8%, healthcare about -7%. So for a while, healthcare and energy have been underperforming, and we saw that reversal with all the uncertainty in the first quarter. But now that I think some of the dust, not all of the dust, has cleared in the tariff situation, we're seeing kind of that reversion to the mean that we've seen over the past few years. Um, while the April market drop in relation to tariffs saw valuations come down, the subsequent rebound has the S&P trading about 35% above its 20-year average valuation. So, valuations were high prior to the tariff shock, and obviously things dropped a bit as a result. But obviously we've kind of come back from that, and obviously valuations are still around near historical highs, especially for the past 20-year period. Also of note, while valuations are relatively high, earnings growth still remains relatively strong, and I think a lot of that is powered by that AI theme that we talked about, driving efficiencies. So I don't think anything to be overly worried there, but definitely something to watch in terms of earnings growth and where valuation sits relative to that as we kind of move forward. And then just another note, there are definitely some worries that the levels that we're seeing today in terms of valuation may be driven by tech AI over exuberance. If you look back further than this graph goes, but kind of towards the early 2000s and the dot-com bubble, the valuations where we're sitting now are still well below the highs that we saw during the dot-com bubble. So like I said, nothing to be overly worried about there, but certainly important to monitor valuations and earnings growth going forward as we kind of extend this AI run here. So you can go to the next slide, please. So talking about consumer confidence. So consumer confidence index dropped by 5.4 points in June, falling to 93 from 98.4 in May. So a pretty significant drop off there. We also have the present situations index, which is based on consumers' assessment of current business and labor market conditions, and that was down 6.4 points in June to 129.1. June's drop in confidence was shared by all age groups and almost all income groups. It was also shared across political affiliations, with the largest decline among Republicans. So, as we talk about how the second quarter played out, we had the big tariff shock in April, and those got kind of pushed down the road, and the market reacted positively. But what we're seeing from consumer confidence data is that there's still a fair amount of uncertainty and anxiety among consumers about what the end game of tariffs is going to look like. Inflation and high prices were another important concern cited by consumers in June. There were greater mentions in the report of easing inflation compared to the month prior. And this kind of makes sense. This is in line with cooling inflation expectations from consumers. The report also looks at consumers' outlook on stock prices, and those continue to recover from April's low, with about 45% of consumers expecting stock prices to increase over the next 12 months. That was in June, and that's up from 37% from 2 months prior. So obviously, some renewed optimism off the back of the tariff scare, but still some uncertainty there among consumers. And then on the topic of interest rates, about 57% of consumers surveyed said they expect rates to rise. That's the highest share since October 2023. So interesting little tidbit there. I think obviously tariffs are inflationary by nature, so I think that consumers, are expecting that, the inflation may begin to take off there. Obviously this, with the amount of uncertainty that we've had, it's kind of, too soon to tell what the end game is going to be there, but consumers are kind of bracing themselves for that. If we can move on to consumer spending, and this is just the graphs we talked about. So this is perceived likelihood of a U.S. recession over the next 12 months, obviously elevated in April, and it's come down. But if you look at kind of where we were this time last year, we're obviously still elevated, and obviously that has a lot to do with the tariff uncertainty. This is a family's expected financial situation. So what's important to note here is kind of the gap between expectations that are assumed to get worse and expectations that are assumed to get better. We saw in April that gap shrink, obviously, projecting worse financial situation. But we've seen that kind of scale back and kind of widen the gap over the last 2 months as the uncertainty has died down a bit. But obviously, if you look kind of pre-April, the end of 2024, the spread there is still a little bit bigger than it is now, which obviously reflects some of that, additional uncertainty. All right, consumer spending. So despite a cautious outlook for many, recent data is still showing a pretty resilient U.S. consumer. Spending increased about 5.5% in the first quarter from the same period in 2024. In March, we saw a pretty big jump in consumer spending, and that was mainly driven by consumers buying cars to get ahead of the tariffs. Subsequently in May, we saw a decline in spending that was heavily dragged by vehicle purchases, as well as some discretionary spending like hotels and restaurants, as consumers became a bit more cautious with their outlook. But kind of the main theme here is I don't know if there's a lot to read into in the May report other than the large decline in motor vehicles, obviously coming down off of the peak that we saw from tariffs. So just important to monitor that going forward. And obviously, consumer spending is a big part of GDP and the health of the labor market. So will be important to monitor that going forward. And then looking at core retail sales, and that core retail sales excludes autos, gasoline, and food services. So obviously, excluding autos is kind of gives us an interesting look given what we saw last month. And that rose 0.4% in May. So positive signs for the consumer. Obviously, like I said, we're going to have to wait for the months ahead to kind of see what that means and how the auto sales play out and how core retail sales play out. But I think taking out that large decrease that we saw that was associated with kind of the come down from tariffs, I think a positive sign that core retail sales were up in May. We can move on to the 10-year Treasury. So the 10-year Treasury peaked in mid-May around 4.6%, and that was kind of amid deficit concerns and also some weak auction demand. We ended the quarter about 4.2, 4.3. That's much lower than the first quarter's peak, which we saw at about 4.8% the first 3 months of the year. And that 4.8 stemmed largely from, again, tariff uncertainty and inflation concerns, but down towards that 4.2, 4.3% range, kind of as most of the uncertainty about tariffs has subsided. But obviously, going forward, as we kind of see, letters being sent out by the administration, that could obviously change things, and hard to tell what the administration is going to do. So obviously, important to monitor that going forward as well. Moving on to CPI inflation. So in March, we saw a month-over-month CPI decrease of 0.1%, and that marked the first decline since the pandemic, actually. In April, CPI rose by 0.2% month over month, but that was actually slightly below what economists had expected. They expected a 0.3% increase, so positive news there. And then in May, CPI rose by 0.1% month over month, and this increase was less than the 0.2% increase predicted by economists. Annually in May, inflation was 2.4%. Obviously, when the Fed is looking at interest rates, they tend to look at PCE inflation, which tends to focus on both urban and rural households and adds in some spending that's done on behalf of households by third parties, which CPI doesn't really take into account. But by all accounts, CPI relatively moderating, I think, over the past few months. Important to watch that going forward, along with the labor market to kind of, try to understand the path for Fed rates going forward. But we can move on to PCE inflation as well. So like I said, PCE, really the Fed's preferred gauge for inflation. In April, we saw PCE jump by 0.1%. That was relatively in line with expectations. And then in May, it rose again by 0.1%. Again, in line with expectations and in line with previous month's jump. You can see on these graphs, really PCE and CPI as well spiked in the aftermath of COVID. And we've really come down since then. I think it's important to kind of zoom out a little bit and kind of realize where we are. The Fed's target is 2% for inflation. So we've made our way down there. Obviously there's still work to do. Important for the Fed to monitor inflation, to monitor the labor market, to make sure that they're cutting rates appropriately. So generally I think in a good spot, but obviously a little bit of work to do. But relative to where we've been over the past few years, I think everyone's happy to see inflation down, closer to 2% than it was. On that topic, we can move on to the labor market. So the unemployment rate in the second quarter stayed in the 4.1 to 4.2% range that we've really seen for the past year or two. Payrolls, which are a proxy for hiring, they stayed fairly consistent around their 12-month average of about 146,000. We did see private sector payroll growth slow, with healthcare and the government driving a lot of the increase there. Additionally, there are some concerns that seasonal adjustments with hiring numbers may have positively skewed our most recent jobs report that we saw for June. In June, we also saw increases in Black unemployment with little change for other demographics. And then we also saw the number of long-term unemployed, marginally attached to labor force, and discouraged workers also rose in June. So like I said, there is a bit of uncertainty in the labor market right now. Again, I think a lot of that is driven by tariffs. You have companies that are trying to plan for the next 3-6 months, the year out, and the tariff situation, whatever way that ends up kind of settling out in the long run, is going to affect how they hire. So I think that's reflected in some of the labor market data that we saw in the second quarter. But going forward, I think the labor market is probably going to be the bigger focus for the Fed as long as inflation tends to continue to moderate or kind of stay where we've seen it over the past few months. Keeping an eye on these hiring numbers to gauge the health of the labor market, I think, is going to be pretty paramount for the Fed's decision going forward. So on that note, we can talk about the Fed and interest rates. Like I said, in the second quarter, we saw some moderation of inflation, but like I said, still sitting above the Fed's target of 2%. We talked about the labor market showing some cracks, and I think as a result of that, we didn't really see. That's mainly why we didn't see rate cuts from the Fed over the last 3 months. We do have an FOMC meeting later this month. The expectation there is that rates are going to hold steady. I think the data is just a bit too mixed right now to kind of make a decision, and I think that traders are pricing in about a 5% chance of a cut there. I think that the bigger chance for rate cuts, at least that traders are pricing in, is going to be in September. So it will be important to kind of monitor the data going forward, interest rates, the labor market, to kind of see how the Fed reacts there. But we can move on to GDP next. So first quarter GDP shrank by 0.5%, and that was largely due to the surge in imports that we saw that was driven by businesses and tariffs kind of stocking up before the implementation of new tariffs. First quarter GDP was actually revised downward in its third estimate, showing a contraction of 0.5 from previous contraction of 0.2. The second quarter market rebound is expected to reflect a bit of a return to normal from the import front loading that we saw in the first quarter. Not necessarily reflecting kind of an upbeat consumer spending. So, just like we saw in the previous few releases, it'll be important to kind of look into consumer spending data and kind of see what's driving any type of change. Because obviously, we saw a decrease in Q1, obviously driven by a lot of the tariff front running. But I don't know if you look at Q2 and you see a pretty large increase. Obviously, I think the first thought there would be that it'll be a kind of return to normal given that tariff uncertainty has subsided a bit. But it will be important to dig into that as well. We have advanced estimates of second quarter GDP coming out this month, and like I said, I think a component breakdown of that estimate should be pretty telling about where economists see GDP going in the second quarter. Some of the bigger news from the second quarter is obviously the new tax bill. So it was passed by the Senate on July 1st, and it was signed by the president on the 4th of July. And it combines tax cuts with some major spending shifts. There's really a lot in this, so I'll try to hit on some of some of the more high level points, some of the stuff that I think is a bit more important there. So some of the highlights: permanently extends individual tax brackets that were initially part of the Tax Cuts and Jobs Act of 2017. It nearly doubles the standard deduction. We also see under this bill no tax on tips or overtime. That's up to 25K for tip workers, 12.5K for overtime, and then 25K joint on the overtime. We also saw the SALT cap raised from 10,000 to 40,000. Basically, this just increases the amount of state and local taxes that taxpayers can deduct from their federal taxable income. There's a phase out beyond $500,000 in income, and then it also reverts back to that 10,000 level in 2030. Some other highlights: the new bill reinstates 100% bonus depreciation and immediate expensing of U.S. R&D. It withdraws many of the Biden-era clean energy tax credits that we saw, and it also raises the debt ceiling by about $5 trillion. Some of the cuts that we've seen are to things like Medicaid and Planned Parenthood, as well as some stricter eligibility requirements for SNAP. The legislation raises the age limit for SNAP work requirements to 64, and also includes parents of children over the age of 14. And I think more importantly, it also limits states' ability to waive these requirements in areas with high unemployment. So part of the cutbacks there to offset the tax cuts. The tax foundation estimates approximately $5 trillion in lost revenue to the federal government over the next 10 years as a result of the bill, with about 20% of that being offset by spending cuts. So as a result, the Bipartisan Policy Center projects that the bill is going to add about $3.8 trillion to the federal deficit over the next decade. Critics argue that the bill disproportionately benefits the rich, and that the spending cuts, I think specifically the SNAP, may adversely affect low-income Americans. Critics also argue that the tax cuts and the spending increase provisions are more front-loaded. So a number of those provisions are set to expire in 2028, 2029, but many of the offsets, so you think like spending cuts, credit repeals, the SNAP work requirements we talked about, don't begin until 2028. So there's a bit of a mismatch there. Obviously, advocates for the bill are advocates for lower taxes to obviously stimulate the economy. But it'll be important to kind of see over the next 5 years, the how this affects the deficit, some other things, wealth disparity, things like that. But really just the beginning stages of that. So we'll see how that pans out. We can move into just some commodities. So oil, we saw an early quarter slump, really caused by weak demand as well as increasing OPEC production. But the conflict between Israel and Iran really pushed prices higher towards the end of the quarter. But we did see those moderate a little bit. I think there were fears that Iran was going to close the Strait of Hormuz, which really caused oil prices to spike on what was perceived lower production or lower access to oil. But that didn't end up being the case. We've kind of seen oil moderate to a bit of a slightly elevated position relative to where it was on average at the quarter, but obviously much lower than the peak that we saw toward the middle of June there. Another commodity that's gotten a lot of attention is gold. Gold really took off over the past 2-3 years, and especially during all of the tariff uncertainty as kind of a safe haven asset, a store of value. So for the second quarter, gold hovered in the $3,200 to $3,400 range, as we kind of saw the market rebound from April's tariff-induced sell-off. Obviously the peak of uncertainty from tariffs was really in the first quarter, and that's where we saw kind of the big run-up in the price of gold. But as the tariff uncertainty has moderated a bit, as the market has recovered from those tariff lows, we've seen gold kind of flatten off in the second quarter of 2025. USD, US dollar, has also gotten a lot of attention. The USD continued to weaken in the second quarter. While I think largely driven by tariff uncertainty in the first quarter, government spending has really taken a front seat when we talk about the tax bill. kind of as tariff tensions moderate there. So I think that we've seen the U.S. dollar continue to fall even as tariff uncertainty is moderated, and I think a lot of the pressure now is kind of coming on the budget and the fiscal deficit side. So you talk about the new $3.3 trillion tax and spending bill that was recently passed has raised a lot of concerns about the U.S.'s rising deficit and fiscal responsibility. We also saw Moody's in the second quarter downgrade the U.S. credit rating. That was in May. And that was the last of the major rating agencies actually to strip the United States of their top credit rating. The dollar index is down about 11% year to date. That's its worst first half in over 50 years. So kind of a combination of those pressures that we just talked about. And obviously, as a result, we've seen foreign currencies strengthen, with the euro and yen, among others, gaining there. If we move on to the VIX, the VIX, or the volatility index, is a market index that measures the implied volatility of the S&P. You can see the large spike at the beginning of April. So the VIX peaked, above 50 at the beginning of April when tariffs were introduced, hitting levels that we hadn't really seen since COVID, and then before that, the great financial crisis in 2008, 2009. Since then, as tariff fears have moderated a bit, or the can has been kicked down the road, so to say, the VIX has moderated and fallen below 20, kind of signaling low expected volatility from the market and somewhat of a return to normal. Obviously, what ends up happening with the tariff situation can obviously drive further volatility, but I think right now, from where we're in April, markets are much more calm about the situation. So current VIX levels still above pre-pandemic lows, so kind of suggests the market still remains somewhat cautious about the tariff situation, but obviously, reduced from the much elevated levels that we saw in the beginning of April. And then one of the bigger stories, of this quarter, the last few quarters, has been tariffs and trade deals. August 1st has been pushed as the new hard deadline for countries to reach trade agreements with the U.S. That was initially July 9th last week, but has since been pushed out to August. President Trump has begun sending letters to countries warning of reinstatement of reciprocal tariffs that were initially imposed in that April tariff scare if a deal isn't struck by that August deadline. We've seen the UK and Vietnam reach trade deals so far. I think those are the more notable ones so far. In June, we also saw the US and China reach what I would call a pre-agreement to formally come to a trade deal kind of at a later date. But I think June and July have seen some escalating tensions on the tariff front. I think that Trump has kind of ratcheted up his threats as that August deadline has gotten pushed out. I think there's a lot of pressure to get trade deals done, and as a result, I think tensions have built up a little bit. But relative to what we saw in April, the market doesn't really seem to be as sensitive to tariff news as it was, 3 months ago. So we'll see kind of as the August deadline kind of gets closer, how the market reacts, what trade deals we're able to make, or if potentially we'll see another deadline extension. And then just moving on to kind of an outlook for the third quarter, the summer months tend to be a pretty good time of the year for the market. We obviously have a lot of momentum coming off the tariff bottoms in April, and a really good quarter for performance for the major indices. Trade deals and Fed decisions are likely going to be the main catalyst for the market in the third quarter. Some other things to watch. We currently are right at the beginning of second quarter earnings season. Growth is obviously front of mind. I think hiring is obviously front of mind. It'll be interesting to gauge, executive perspective on the current trade environment from Q2 earnings calls. At the beginning of kind of the tariff uncertainty, we saw a number of pretty large companies suspend guidance, kind of amid all the uncertainty. So will be important to keep an eye on the tone change there to kind of see how businesses are kind of reacting to the tariff environment that we're kind of currently in. Obviously, tariffs and trade deals will be key. The August deadline looms pretty large right now with a handful of trade deals still left to make. I wouldn't really rule out the possibility of the reinstatement of tariffs, but given what we saw in April as well as the market reaction over the past few weeks with the heightened tariff threats, I wouldn't really expect as severe of a reaction if we saw some type of re-escalation in tariffs compared to what we saw in April, just given the experience that the market has with that. But obviously, if things are much more severe than they were back in April, we could obviously see something of similar or worse scale there. And then also, just obviously inflation and labor market. Like we talked about, inflation has moderated over the past few months, and while slightly above the Fed's 2% target, progress has been moving steadily in the right direction. Obviously, the labor market has been getting more attention recently as there have been some cracks showing. So, kind of monitoring that data over the next few weeks will be really key. The labor market has been pretty resilient over the past few years, despite many forecasts for a recession going back to right after COVID. This isn't really the first time over that span that there have been concerns about the labor market. So it's not causing a problem, but I think something to kind of monitor, as time goes on here. Obviously, the Federal Reserve and interest rates are going to be key to monitor. Like I said, traders are pricing at about 2 rate cuts this year, with the first expected to come around September. The Fed's really been in wait and see mode, kind of amid all of the tariff uncertainty. So, if the August 1st deadline for tariffs is honored, we should have a better idea of where everything stands at that point, and that may give the Fed a little bit more confidence in their decision making going forward. And then the last point, just on valuation, valuation still remains historically high, which means that continued performance is likely going to need to be continued to be driven by earnings growth. We saw the AI theme rebound in the second quarter, and I would expect that to be one of the main drivers of return going forward this year. We also talked about the AI period drawing comparisons to the advent of the internet and the technology bubble in the early 2000s. Obviously, valuations are nowhere near the highs that we saw before that crash, but I think important to kind of monitor going forward and to monitor kind of any level of exuberance or over exuberance to kind of avoid a kind of situation like that. But right now we're not really near the heights that we saw then, so just something to monitor as well.